Warren Buffett and Berkshire Hathaway have an incredible $350 billion with which to invest. That's the cash that's just sitting on their balance sheet. So, what stocks should Warren Buffett be buying today? I'm going to give three phenomenal ideas that I think Warren Buffett should be buying. But let's start with what Buffett looks for first. There are some trends that Warren Buffett has demonstrated over the course of his long investing career. He likes durable competitive advantages, things like brands, network effects, regulated monopolies. It's something that he spent a lot of money on over the past decade. And companies with cost advantages. He also wants an operating history. He doesn't invest in startups. He doesn't invest in early stage companies. He wants to know a company can be profitable and that has demonstrated that long term. He wants high return on equity and low debt. And of course, good management. That's tough to judge, but a good management team is something that he's always looking for. And then, as always with Buffett, he wants a good valuation. With that in mind, here are the three stocks that I think Warren Buffett should be buying today. First is one of the biggest companies that could actually impact that massive cash position in Berkshire Hathaway's portfolio. That is Alphabet. Alphabet has a massive business and a massive moat around particularly its search business. Now, there's plenty of questions about what is the future of search? How is that going to be monetized in the future, especially with artificial intelligence potentially disrupting that business? But that's a perfect opportunity for Warren Buffett. Those questions give the value that Buffett is looking to buy. When he was buying shares of Apple in the early to mid 2010s, the valuation of Apple was relatively low because there was a lot of questions about how durable was the iPhone and the products that Apple were making. And he made a massive bet on the company, and that paid off, eventually being 50% of his overall portfolio. But search continues to grow, and it is an incredibly profitable business with a compound annual growth rate of nearly 19% over the past decade. That's exactly the kind of core business that Buffett is looking for. And then you have adjacent products like YouTube, like the Google network. That's the advertisements that are all over the internet. And of course, Google subscriptions, platforms, and devices. And this is potentially where you're going to see a lot of value from artificial intelligence as more of their AI tools are integrated into the products and services that Alphabet offers as a company. But the growth is really coming from the cloud. Google Cloud is a juggernaut in the making and has now become profitable. Those margins are going to continue to march higher, potentially reaching 20, even 30% over the coming years. On top of all these phenomenal businesses, Alphabet also has a phenomenal balance sheet. There's nearly $100 billion worth of cash on the balance sheet, very little debt, and management has been both buying back shares and also investing heavily in capital expenditures with plans to grow that in the future so that it can take advantage of all of the opportunities in artificial intelligence. Well, I think when you look at Alphabet, the company, the fact that this stock is trading for less than 20 times earnings, this is a stock that is right up Warren Buffett's alley. And I think a huge position is not something I would be surprised to see him take in the future. The second stock may be a surprise, but that is General Motors. General Motors, a U.S. manufacturing company, a vast majority of the revenue does come from the U.S., but they have a lot going on that Buffett should really love. This is an absolute cash flow machine, and it is a very cheap stock. Really, everything you need to know about GM today is in this chart. Despite everything that has gone on with electric vehicles, with tariffs, with the economy, look how much GM's revenue has grown just over the past year. This is not a company that's shrinking. They are taking market share. They are doing it profitably, and they are generating billions in cash every single year. And the auto business actually has a net cash balance. So there's not a significant amount of debt in that auto business. Yes, there is debt in the financing business, but this is not an overly leveraged company. And so management is using this opportunity to buy back shares at an extremely rapid rate, buying back about 20% of all shares outstanding on an annualized basis right now. And despite everything that's happened with tariffs, shares are still trading for just 6 times forward earnings. Management even increased their guidance recently. So GM is going to be a profitable company in 2025. They are likely going to grow, continue to take market share, not only in big trucks and SUVs, but also in electric vehicles. And with that free cash flow, GM can return that cash to Omaha with dividends. They can buy back stock, a lot of optionality. And this is the kind of manufacturing business that Buffett has invested in for decades. The third and final company leans into the brand a little bit more. I mentioned that Buffett loves great brands, and there are few brands globally that match Disney. Disney's been able to leverage that into theme parks, which is really the core business today, generates a vast majority of their operating income. While they do have some declining business in linear TV, there's also a lot going on in streaming that's moving in the right direction. And that combination of the foundation with the parks and the growth with streaming and the brands that Disney has is the kind of thing that I think Buffett would be very interested in. You can see here that the experiences business is just steadily growing right now. It's generating almost $10 billion in operating income. And this is before a lot of the investment, that $60 billion investment that they announced in the experiences business to build new cruise lines, to build new expansions to parks. That has yet to pay off yet. That's going to start to pay off in 2025, but we're going to have a decade of growth in the experiences business for Disney because of all that investment. So I think this is the foundation for the company. But this isn't the only cash flow machine. Remember, Disney owns 80% of ESPN. That's the sports segment that you see here. You can see that that is still, after everything that has happened with linear TV, generating $2.7 billion worth of operating income. And that's even before ESPN goes over the top this fall. Within the next couple of months, we're going to see ESPN streaming. I think that will open up new growth opportunities for the company, and they will be able to generate more revenue per user. Not only with that $30 per month fee, but also the advertising that comes along with it. Streaming is going to be a growth driver for the sports business. And let's, of course, not forget about Disney Plus and Hulu. Those businesses have now become profitable. And so as operating leverage starts to kick in and you start to bundle with ESPN, that direct-to-consumer business is going to go from about $6 billion in quarterly run rate revenue to potentially over $10 billion in quarterly run rate revenue. That, by the way, is what Netflix is generating. So Disney's streaming service could be bigger than Netflix within the next year or two. And you get all of these businesses for about 21 times forward earnings. That's not a cheap stock, but given the leverage and the improvement in streaming, I think this is a phenomenal value. And this is the kind of company that Buffett would just buy and hold for potentially decades. So there you go. Those are 3 stocks that I think Buffett should be buying today. Alphabet, General Motors, Disney. What do you think about those 3? Let us know in the comments section below. Those comments make us all smarter as investors. And of course, check out Fool.com to get the top 10 stocks to buy right now. Thanks for watching, everybody. We'll see you here next time.